Hello and welcome to Crux Investor. We caught up with Spencer Cole today, EVP for North America for Vox Royalty. These guys are our number one pick from Royalty Week, and as a consequence, we have invested into them. We talked today about share price movement. We took a look at their Q1, the record Q1 revenue. We also look at their asset handbook, which they're looking to put out in the next couple of months or so, and ways that royalty and streaming companies can make it easier for retail investors, and I guess some brokers and analysts, to work out what it is that the companies have got and how to value them properly. If you want our thoughts and opinions on this conversation, you can find that at cruxinvestor.com/club, where you can also find detailed company reports and analysis. We've got commentaries from experts around the world on a variety of companies and commodities. Plus, we've got training courses on there. We've done summaries of all the interviews that we've done just to save you some time, because we know you're busy people. But most excitingly of all, we've got a wonderful community of investors sharing their thoughts and ideas with each other in a nice, friendly and safe environment, free from all that judgment, trolling and abuse you see elsewhere. There's a bit of a wait list, but it's well worth it if you get in there. So you can join them at cruxinvestor.com/club. We'd love your feedback too. So give us a like, leave your comments below. And if you want to see precisely what we talked about today, do take a look in the description below. Spencer, how are you, sir?
Very well, thanks, Matt. Yourself?
Not too bad. Not too bad. How's life over there? Toronto, all good?
Yep, we're surviving. The vaccine doses are slowly but surely starting to roll out.
Beautiful, beautiful, beautiful stuff. Well, also some other good news that I've seen today. Record revenues from Vox Royalty. Do you want to tell us all about it?
Absolutely. So yeah, we're very excited this week to announce record Q1 quarterly revenues of 669,000 Canadian. And this is enormously exciting for us because we've been guiding investors for some time towards the fact that we're right on the cusp of sort of exponential revenue growth, just based on the fact that we've been acquiring some really attractive pre-production royalties. So yeah, we're very excited about this to release this news to the market, Matt.
Were you kind of expecting it this year? Because I mean, if I look at brokers' reports, I look at the work we've done, there's an expectation this really kind of kicks off in 2022. So is this you getting ahead of yourself? Is this something that you expected?
No, I mean, we previously provided a revenue guidance for this year of 1.7 to 2.5 million Canadian. And, this quarterly result is in line with that previous guidance. So we fully expected this range of revenue for this calendar year. I think importantly, we started the year, or we went public rather, May of last year with only one producing asset. And we're on track to finish this year with 7 producing assets. That's without any further acquisitions. So I think this is really just a natural maturing of the royalty portfolio. So yeah, we fully expected this evolution.
Okay, well let's just talk about this, because there's two aspects to what you're up to here. One is the LOIs, which I want to pick up on. We discussed them last time you were on the show. But sticking with current royalties, talk to me about Cooley & Nobbing, because you have decided to extinguish the prepayment there. There's about $1.7 million, if I'm not mistaken. Why did you do that?
Sure. So the history there for viewers who aren't familiar with it, we acquired the Cooley & Nobbing producing iron ore royalty from a telecommunications company. And historically, the predecessor company to that had actually been prepaid a balance of $3 million on that iron ore royalty. So at the end of March this year, we opportunistically elected to pay back or settle the outstanding prepayment balance on that royalty, which is about $1.7 million. And we made that decision for a few key reasons. Firstly, iron ore prices, particularly in Aussie dollar terms, are at record levels. So we thought, now is the right time to capture that cash flow. Secondly, based on satellite imagery and feedback from the operator, the $7 billion mineral resources ASX listed company, we could see that production on the royalty claims was likely to be expanded because they were commissioning a new deposit that was fully royalty linked called Altair. So I think those were two of the key reasons that we wanted to bring forward that cash flow. And I think the third reason was, Matt, Cooley & Nobbing has been producing for some time, but because of this prepayment, we haven't been seeing the benefit of that cash flow. So, I think in terms of our multiple and where we trade, on the TSX Venture, we haven't been getting the benefit of the multiple arbitrage or re-rate based on that cash flow. So I think part of it was, and this is being candid, part of it was, we want to be trading at a premium multiple, and one of the levers to do that is to be able to demonstrate cash flow generation. So there was obviously a small cost of capital requirement to bring that to settle that prepayment. But we're very confident now, having these Q1 revenues out, that that was absolutely the right decision to bring that cash flow forward for our shareholders.
How much did it cost you?
I think when we project ahead on how the prepayment would have been extinguished, it was probably about $75,000. So it wasn't cost neutral, but certainly when we look at the incremental revenue it's unlocked, to the bottom line, for the multiple re-rate that we see coming from that incremental cash flow, we're very confident that was the right investment decision.
Okay, and when you talk about this, the re-rate, again, just for people to understand what it is that you're trying to achieve, like revenue, 668,000 Q1. Great. What are you targeting? You said 1.7 to 2.5 this year. What's your market cap today?
It's about 90 odd million.
Right. Okay. So with royalties, I mean, what's the game played here in the market in terms of re-rate? What does that mean for you? How do you go about affecting that? Yeah.
So I think, you can value royalty companies based on, a number of different conventional metrics. There has been this quite a key focus on cash flow generation in the industry for the past few years. And we're certainly no exception to that. I think one challenge that we've had in terms of educating the market to our portfolio is that for some time we've said that we've been deliberately buying royalties that are immediately pre-production. So call it 3 to 18 months out from first production. So the positive is we're able to continue to find royalties at fantastic prices that, in that sort of pre-production bracket. The downside is obviously it means that from a revenue perspective, last year we were pretty much pre-revenue. So going back to your question, what does that sort of arbitrage or multiple re-rate look like? I think there's a base level of revenue and cash flow that investors expect, and we're delivering that this year. And then next year and the following year, we expect to have, significant growth on top of that revenue. But being a pre-revenue royalty company, I think it's fair to say it attracts a discount in the market. So we're not the type of company to be about, playing multiple arbitrage. But the reality is investors expect a certain amount of cash flow, and Cooley & Nobbing, helpfully adds that a key part of that cash flow. Right.
So it made sense. 75 grand. That was, as far as you're concerned, money well spent on that basis.
From where we're sitting, absolutely, and from the technical data that we're looking at on Cooley & Nobbing, we're very confident that was the right investment to make.
I'm kind of interested in the timing as well, because obviously I know you've been around in a private form for a number of years, but you've gone public last year, or relatively recently compared to some. Was this a kind of marketing exercise? You wanted people to register the fact that you are revenue flowing, that you are doing what you said. Is that part of the mix here? What was the trade-off?
Yeah, I think it was twofold, Matt. One was the technical aspects. So, these record iron ore prices, most analysts would agree, are not going to be here forever. And capturing that price window plus, where we could see, the production was going to be increased on the royalty tenure. I guess that's a more technically driven decision that, now is the time to capture that immediate sort of that revenue potential. And then the less fundamental aspect or more market-based, relative valuation aspect was, as you said, it was, how do we work towards Vox trading at a premium multiple? And one key part of that is demonstrating cash flow and revenue generation, which frankly, we've been discounted for that very reason. And Cooley-Nobbing was a key part of sort of, removing that valuation discount.
Okay, and the reason I'm asking is because when we've done our sort of analysis and sort of looked and spoken to lots of the royalty and streaming companies in the space, a big part of the game, it seems, for some companies is more about the promote than the fundamentals. And I'm just wondering, are you veering to that style of company? Do you recognize, or do you believe that?
No.
Well, no. Go for it.
Yeah. No, it's a good question, Matt, because, we at the core of our DNA is prudent capital allocation. So to be absolutely clear to listeners, so our total net cost for this royalty is still about 3.5 million Aussie. The royalty is generating approximately about $1 million a year. So, when you look at it on a return on equity basis, internal rate of return basis, the Cooley-Nobbing iron ore royalty is still an incredible investment for all of our shareholders, even with the prepayment settlement that we mentioned before. So this is certainly not Vox, changing its strategy or moving away from being prudent allocators of capital. This investment is still, one of the best investments in our portfolio. So nothing's changed from that perspective. And, every time we allocate capital, whether it's to a new royalty acquisition, to something like a prepayment settlement, or even, our recent buyback activities, it's always through the lens of shareholder value. How can we unlock the greatest alpha for shareholders? And, when we're trading at a discount to our peers, we're trading at a price to NAV of 0.7, 0.8 times. And, the rest of our peer group is trading at closer to 1.5 to 2 times. That is the greatest lever that we have to try and unlock value for our shareholders is really focusing on what creates that premium multiple in the market.
Okay. So you've got, by the end of this year, 7 paying royalties. You've got 50 royalties in total, about 30 of those are exploration. So what can we expect next year? I know, so if you're again looking at brokers' notes, with people suggesting that you beat 6 million next year. Is that in line with what you were talking about internally?
Yeah, so we haven't provided formal guidance to the street for 2022 as yet. As you mentioned, brokers have us going from about 2 million this year to 6 million next year, and then I think towards $8 million the following year in top line revenue. In terms of what investors can continue to expect from Vox, based on our existing portfolio of 50 royalties. So I'll break it down into three buckets. You touched on the production stage assets. So organic growth from what was 1 producing asset when we went public last year to 7 by the end of this year. And then from a development perspective, we've got a number of key assets that are approaching a construction decision, such as Lynn Lake. Alamos is guiding towards a construction decision on that asset, within the next 12 months. Our Bowden silver asset, which is the largest undeveloped silver project in all of Australia, they've just applied for their mining lease. So that's moving towards a final construction decision. And then, we have a number of other assets such as the Sulphur Springs copper and zinc asset, that they're doing early construction works. So from a development perspective, we've got a number of key assets that will add, in the multiple millions of dollars of annual revenue that are approaching construction decisions. And then from an exploration perspective, we're continuing to have about 120, 130,000 meters worth of partner-funded drilling on our exploration properties each year. So just a huge volume of monthly news flow through the drill bit, where our operating partners are aggressively drilling those properties out. And I think the extra surprise on the upside for investors is in that bucket of about 30 exploration royalties. Brokers typically don't really go into a huge amount of detail there in valuing those assets, which is totally fair enough. I mean, even valuing 20 advanced royalties is, brain damage enough, frankly. But those 30 exploration royalties, there's a number of those that are aggressively being moved forward towards production, such as, our Mount Moss royalty that we acquired last year, that is a historical producing mine in Queensland. The new operators guided towards bringing that back into production this half. So we'll wait and see how that progresses. We've got an exciting vanadium discovery in Brazil, Piton Beiras. They've just announced their PEA, and that they're planning to move into trial mining Q1 of next year. So within that exploration bucket, brokers don't typically value it more than just book value, but we're seeing a lot of surprises on the upside there for shareholders that point to revenue generation far in excess of what we paid for those royalties as soon as end of this year, early next year.
What I found interesting looking at the royalty space was the way that companies present the information, and it may be difficult, but it'd be really useful for regular investors like us to be able to look at the performance of each royalty. So, for instance, you're at the end of this year, 7 paying royalties, but what's your expectation on how long those payments will go on for? Do they ramp up? Do they ramp down? What's that cash flow profile look like? That would be a nice industry norm to do. Do you know what I mean? Because it's you talked about multiples and so forth earlier, but they seem to be a very casual attribution as to how that works.
Yeah, I've got a lot of empathy for investors in the royalty industry, Matt, because it's enormously sort of time and labor intensive to value a royalty company, and so obviously picking up broker reports is the surest way to do that in an accelerated time frame. But even for us being obsessive about the royalty industry, we're constantly benchmarking, our own deals and then the deals of our competitors. But there is a fundamental disclosure gap where forecasting ahead exactly what the mine lives of each of these different royalties will be is very difficult. So if I talk about our portfolio, for example, Koolyanobbing that we talked about just before, that has about a 7-year reserve life on it, inclusive of the full resource. That's closer to 15 years. And when I look at other royalties such as Higginsville, for example, we can point to, based on the deposits that are currently being mined, that's probably a 4 or 5 year, mine life that we can point to. But then there's some other resources that are royalty linked in the paleo channels, that could point towards, closer to 10 years. And our Browner asset is probably closer towards the sort of 5-year mark in Brazil. And a number of our sort of development stage royalties are north of 10 years. So Bowden's, is around about the 12 to 14 year mark. And then we have a few other key development assets that are around about the 15, 16 year mark, such as the Montanore silver and copper asset in the USA. But yeah, it's really difficult, for outsiders looking into the industry to be able to say, okay, that is the exact IRR that I expect from that royalty investment, because there's obviously a lot of inputs that go into it.
No, and I understand that, but the company kind of gives guidance about the size of a resource, life of mine, etc. There's some very crude numbers that could be applied, and maybe some very crude discounts that should also be applied as a result. But it's a difficult, even reading broker reports, because I don't think much work goes into those, quite frankly, either, to be able to discern, what is a company that's focused on, cash revenues and trying to understand what that actually looks like going out. Because again, some of the multiples seem a little bit optimistic, put it like that.
Yeah, no, I fully agree with you. Like, one thing we're working on in the background that, I must admit is, it's a big piece of work, and it's something that will take a bit more time. It's a piece of best practice that we see that the likes of Franco-Nevada and even some of the intermediate groups like Mavericks have is an asset handbook. So an asset handbook being a key sort of, I guess, the Bible for that royalty company, explaining their key royalty properties. And we're working on that, preparing that at the moment, to try and sort of help investors get up to speed on our royalties. The problematic part is, annoyingly, we keep adding more royalties. So we keep creating more work for ourselves to add more pages to that asset handbook. But once that's completed, that will be quite an instructive document for our investors to be able to see, okay, this is how much of that ore body is covered by the royalty. This is what I can roughly, should be roughly expecting in terms of life of mine for that royalty.
That'd be fantastic and well received, I'm sure. So yeah, and hard work. That's what you've got on the books now. Let's talk about some of the things we talked about last time, was these LOIs. Your 10 LOIs. Now, LOIs are just that, right? There's optionality on your side. There's diligence as well to be done. So how many of those 10 LOIs have actually gone anywhere? How do they kind of fall away? Because I guess you've got lots of projects on the go at any one time, lots of LOIs at any one time. But what's the sort of percentage return on that? How quickly do you get to the point of actually we don't want to do those? There's something here, but we can't agree terms, or someone else trumps you to it. I mean, how does it all break down?
Yeah, so it's a good question. So you're absolutely right that when we completed our financing, we were talking to investors about 10 potential deals that we had under letters of intent. So since we last spoke, we've acquired 3 separate royalties, 3 gold royalties in Western Australia. So that was the producing Janet Ivy royalty, the pre-production Otto Bore royalty, and the very large sort of development stage Bullabulling gold royalty. So those are three royalties that were part of those 10 royalty deals. So in the background, we've obviously been working on confirmatory due diligence to make sure that all the other letters of intent and the royalties that they cover, are up to our internal investment thresholds and standards. So there have been some that, based on confirmatory due diligence, we found some technical hairs that, we didn't feel presented the right risk-adjusted returns for investors. So, we won't be completing on 100% of those 10 LOIs. And then somewhat frustratingly in the past month, we've actually had 3 royalties that have been snapped up away from us by operators under rights of first refusal. So, in the past 12 months, I think we've lost about 7 separate royalties to mining companies where, we continue to price deals in favour and, we will never overpay for royalties. But the downside is when the royalty agreement has a right of first refusal, often we find we're serving the royalty up on a silver platter, the mining company, and a lot of them are pretty well cashed up now. So yeah, it's been frustrating in the last month to lose 3 separate royalties to mining companies under ROFRs. But that just is a testament to how we're pricing deals. So what can investors expect over the coming months? There are a number of deals that we have under LOI that we previously foreshadowed during the financing that we fully expect to be announced in the coming months. But as we've always said, Matt, it's not a volume game for us. It truly is a value game. So investors can feel confident that how we're allocating capital and the deals we'll be announcing over coming months, meet very rigorous technical and financial hurdles, such that the cash on cash returns that they'll be generating will be very attractive.
Okay, and one question to leave you with, Spencer. I'm looking at the share price. When we first started talking, it was around sort of $3. You announced the raise, and I think fair enough reaction in the marketplace then, but it really then took a pummeling thereafter. I mean, what on earth was going on?
Yeah, no, absolutely, Matt. And look, as management, we own 15% of the company, and so we're long-term shareholders ourselves, obviously. So the reality is we're not happy with where the share price is at all today. I think coming through the financing, so there were a number of very large precious metal investment funds who wanted the upside of a warrant, and so to bring in some really fantastic long-term precious investors, we included a half warrant as part of our financing. Now, the downside to that is that warrant obviously attracted a certain type of, shall we say, shorter-term hedge fund type investor, and one fund in particular that participated in the raising it's become painfully obvious that they're just interested in clipping the warrant, as they say. So they've been selling out of their position that they picked up during the financing. So we're very frustrated about that. Obviously, we see that as just a very much a short term abnormality, and we believe they've traded out of the majority of that paper. So we remain frustrated by the share price, but that's delinked from the fundamentals of our business. And so as cash flow continues to grow, as our royalties continue to deliver surprises to the upside, the market will reflect that fundamental value. And we can't stay trading at 0.7 times price to NAV when the rest of the industry is trading at 2 times that for very long.
Okay, that makes a lot of sense. So, but just 2 things off the back of that, though, is one, do you go and raise money with warrants or half warrants next time out?
Yeah, I mean, to be honest, we don't love including warrants as part of any financing. So, we won't include warrants unless we absolutely have to. So, and frankly, we won't raise money. We wouldn't even contemplate raising any money at these sorts of share prices, obviously. So we're well financed today. We've got cash flow that's growing. We're in a fantastic position in terms of our balance sheet, and we're not going to need to tap the market. From an equity perspective, we are selectively speaking to some groups about potential debt capacity that would only be used for the right type of royalty acquisitions. But there's a number of non-dilutive ways that we're looking at unlocking value for shareholders that should come to market in the next couple of months. But the short answer is, we would prefer not to issue any further warrants in the future.
Okay, now I'm glad you answered that. I was kind of getting towards the how do you go and raise non-dilutive capital going forward? You've answered that. So the second component is the types of people. At different stages of the company, you're just grateful for people wanting to invest in you. You're waiting. You're not in control. I mean, how do you retain control going forward? Because you don't want those sorts of hedge fund guys playing games with your stock. So how do you fix that?
Yeah, I think, moving forward, we're continuing to sort of work with our major investors to understand exactly their preferences and to make sure that our knowledge of our share register and our relationships with our key investors are as strong as they can possibly be. I think on projecting ahead, if and when we do another capital raising, we'll be very careful about the types of funds that we accept into the book. I think there's obviously some groups that the capital they're offering is just too expensive or has other tentacles attached to it. So, I think we'll be very careful about that, going forward, that, we leave sort of hedge funds to one side and we focus on long-term shareholders who are really aligned with, the vision of what we're building. Okay.
Well, it sounds like you got your hands full there. I definitely want to hear from you whenever you close a couple more of these transactions. I was impressed with both you and Kyle in your description of the business you're trying to build there. So yeah, stay in touch and let us know how you get on, okay?
Absolutely, Matt. Sounds great.